The NASDAQ and micro NASDAQ are among my top favorite markets. They have incredible movement, sometimes maybe too much movement to be fair, great pricing to keep risk lower per tick, and tons of volume to support any size trader for scalping or swing trading. There's definitely a reason why it's among my favorites. It fits so many different types of people that it's hard to ignore. Hey there, John Henry here, SSFTG. Welcome to the video. If this is your first time on the channel, welcome my friend. I hope to earn your like and subscription today. The NASDAQ can be a bucking bronco of a market, and just as fast as your cheeks hit the saddle, they then hit the dirt. You have to be very careful with the NASDAQ and have your risk in check always. My absolute favorite approach to trading the NASDAQ and my go-to NASDAQ trading strategy goes back to the Algo Pockets and zones of interest. The NASDAQ is, after all, made up of tech, so it would kind of make sense that algos play a large role too, right? If you missed the video on Algo Pockets, I'll post it in the corner for you. The idea basically is to figure out where the flip gets switched from a 0 to a 1 for the algos. Basically, where can they start buying and where can they start selling, right? Where do those things take place? This always falls back to one of the easiest things to program that everyone has to program: risk versus reward. They don't have a choice. This has to be a calculation somewhere in their strategy, whether conceivably inherent or not. It's always there, and that means that we can track at all times, at any location, where market algos will be entering. And you can utilize this on any market that you want. But how they respond to each of these zones, that's up to the market. But these areas are so reliable that I can't help but have this on top of my approach to the NASDAQ and really any market. So let's look at a couple examples of these pockets in action. First off, the idea is to understand that our initial drawing, and I use the Fibonacci tool, is going to have a couple different things on it. When we look at the tool in and of itself, I'm going to be utilizing the first couple points. My first drawing, when I first click on the mouse, that's going to be the stop location. The second point that I click is going to be my entry spot. From there, we have our targets to the downside. The 1/2 to 1, which is a scalper's objective. The 1 to 1, which is, well, a regular trader's objective, whatever you want to call it. Then we've got the 2 to 1s, the 3 to 1s, and then of course you can add as many as you want. Don't worry about the extra levels. Those are all part of the L1 package in the Day Trading Academy. That's something else. We won't involve these in this, just to keep it simple. So let's say as an example that sellers want to come in on this move to the downside. Well, if they were looking at this from a risk perspective, where would they put their stops? Well, obviously, this one is incredibly obvious. I think everybody on the planet sees that one. There are some other smaller ones that may stand out, but the only one that really looks like it was a bit of a reset was this one. Those are about the only 2 points that we have to work with. So what that means is when I'm using my Fibonacci tool to figure this out, let's start off of the top since this is going to give us more. We'll go off of the top because that's where the stop placement is going to be, maybe a couple ticks above the high. And then we want to go down, and our entry point, the second click, is going to land wherever our target fits. So as an example, if I were to move this all the way down to, let's say, right about here. Now, why would I click right here as my ending? Well, if we draw this across and we look down to the aggressive scalper's target, right, that first green line, this is inside of the low. So if an algo wanted to short, the primary objective for them to increase their probability and all odds would have a target inside of the high. That means that this point and higher is where they are going to strike. Now, it doesn't necessarily mean that it's going to be at exactly this tick. It might be a few ticks higher. It might be a couple points higher. But that's where it all starts. So if we go a little bit further backward and look at this whole rally to the upside, right? This jumbotron rally to the upside breaks a previous major swing. Looks like the bulls are definitely taking this. If buyers want to be aggressive, their stop is going to be underneath the low. We'll start our drawing from there and we'll work our way up. And we're going to look for a pullback that satisfies anything that allows a target at least back to the highs for scalpers. And you'll notice they were so aggressive that it didn't even catch the bounce. I mean, they missed it by like a point. As the market goes a little bit further up, we can continue tracking where this area is so long as the objective is inside of the high. Now, the objective that you choose is based on the type of trader that you want to be. In the most aggressive sense of things, the algos who are looking to flip the switch on aggressive half to one, buying with maximum risk, that's where they're going to start buying. And it's no wonder that even though it failed and didn't work out in the end, rolling all the way back up to the highs, at least not yet, that doesn't necessarily mean that this can't create incredibly responsive zones. And that's why I love these areas. Because when we track these zones, this allows us an incredible amount of reliability. Even when they fail, we know that the buyers are coming in here. And obviously, they got shut down. So when the market comes back, what are they going to do? Well, they start exiting at break even, right? And then it starts breaking back down to a new low. And when there's more proof that there's wrong, what do you think they're going to do when they come back to break even again? More resistance. Now again, we can choose different objectives. If I want to find out where the one-to-ones are, I'll simply move my entry point down until my one-to-one fits inside the highs if I'm looking to go long. And lo and behold, what do you know? All these bulls started stacking up, not just some random place, but exactly where the algo's switch flipped. And, of course, this one also, at least for right now, didn't work, and it starts breaking down. So where can we expect to see some resistance step up? Right about there. It creates incredible reliability. One of my favorite things when I'm looking for any kind of trading strategy is not the reliability on pattern success. Yeah, obviously that's helpful to have a really high, success rate on good trades. But also have a huge amount of information on trades that don't work. Right? Have a reliability basis on negative trades and trades that don't work out in your favor. When you can still use those same areas, then you know you've got your teeth into the right kind of strategy. Now, another side of things would be looking for the more aggressive 2-to-1 or the swing traders, right? Now, let's say as an example, with this jumbo rally to the upside, bulls want to come in, but they don't want to buy in until they're able to risk down underneath the low as their stop, but with a 2-to-1 or 3-to-1 back up to the highs. So we can easily measure that. We'll go from the bottom with a stop just underneath the lows, and we'll draw up until our green line is where we see a good spot as a target. Right about there is a good spot for our 2-to-1 objective. And it's no wonder there was such an incredibly powerful bounce there. And when it started failing, it's no wonder that there was an incredible amount of resistance there. Now, if we continue this a little bit further, those are the 2-to-1s. The 2-to-1s did incredibly well, but this one went a little bit further. And if we go down to the 3-to-1s, we can really see who kind of won the fight here. The 3-to-1s slid down, back up, and off to the races they go. And all the way back up to the highs. So these can create incredibly reliable zones of interest when they work, obviously, but again, when they fail, seeing reliability on these zones is also incredibly important because that's how you gauge context. That's how you have an understanding of what the market's doing, even when it's doing something that you didn't necessarily want it to do. When you know how to approach it next, you're already one step ahead of the curve. Hopefully after seeing all of these examples too, you can see why I put so much emphasis on these algo pockets. They are crazy accurate, and even if they fail, they create incredibly reliable price action, which is so important to me. If you have any questions, thoughts, topics for a new video, or anything else, drop them in the comments below. I always love hearing from you all. Thanks for watching. Until the next one, have an awesome day.